Hi, good morning, everyone. Just waiting for a couple more people to join, and then we will make a start. Okay, we've got a couple more waiting to join. Just give them a few minutes, and then we'll start our discussion. Okay, we've got pretty much everybody now on board. So let's make a start. Give me 1 second and I will basically share my screen.
Detail, yeah. শনিবার দিন আর ডিটেল হলে আর ইয়াঙ্গাল দিবন চলে আসি ঠিক আছে না ওকে
Okay. Let's start. I'm going to show you profit and loss. And we need to look at income statement and statement cash flows. Okay, let's start. Right, today we are looking at basically discussing the second learning outcome. And this is going to be, primarily related to, knowing the accounting basics. So what we are going to do primarily is just doing my own housekeeping tips before we start. So what we are looking at doing is primarily discussing some accounting basics today, which is the second learning outcome. And the reason I say this is that we need to be able to, understand accounting side of things that we do, from a point of view of, working within a business or, understanding in terms of what, financial statements essentially help us to, when we talk about, financials of a company or cash, about a company. So what I would want to do essentially would be to try and discuss the basics of it today, which is just the one assessment criteria which talks about know the importance of accounting, and obviously looking at in a bit more detail in terms of what are the various types of statements that we need to be aware of, and why is accounting generally useful for the purposes of business. Now, just before I start the recording, what I would do is basically request everyone to mute their microphones. And obviously, a very interesting topic that we're going to be discussing today, because this is something in terms of money, cash flow, finances, whichever we call it, we all come across, this, use of money or related to, the essential parts of managing money in our day-to-day lives. So I think from our point of view, what we want to be able to do is understand, and hopefully there should be a bit of a, interaction on this, because most of us understand money related, money and money related transactions. What is, how do you manage your money? What are budgets? And, how do you put budgets together and things like that? So it is a good, it's going to form a good point of discussion because here we are looking at basically, just discussing the basics of what we require to understand from a point of view of, learning about accounting and accounting measures. Now, let's look at shifting you over to the, presentation. We're going to discuss this particular learning outcome with regards to tipping into a presentation, and also looking at, obviously, a couple of slides and some discussion activities. So let me just quickly move you over to, essentially, the PowerPoint slide, and then we'll make a start. So let me just resume recording. That's great. So thanks so much for joining in today for this session. We are looking at discussing, the second learning outcome in our unit, which is how businesses operate. And today we are going to be focused on understanding the importance of accounting from a basic overview point of view, based from the basics point of view. And I think the idea here would be to try and give you a bit of an overview of how you look at, understanding the purposes of, maintaining financial statements or preparing financial statements, presenting financial data when you're running a business, working in an organization. And that is where we'll be looking at covering the importance of accounting for business success. Money obviously makes the world go round. And obviously, when we look at, the basic pretext of how essentially you would look at running your business, or essentially, look at primarily, let's put it this way, planning for resources, what you would generally see is that it is something which is very basic, because without money, obviously, you can't plan anything. Without money, it is very difficult to look at, paying for things if you're looking at buying things in your business. And obviously, from a point of view of looking at, essentially, say, for example, employing staff and running your finances, it is going to be very difficult for you to be able to, run things without proper finances or money being made available. So let's look at discussing today our learning outcome with regards to, the topic of what is accounting, why is it important for business, and let's look at, obviously running through some of the slides. So we're looking at session 3 today, and we have so far covered, in this session, learning outcome 1, which basically talked about what is a business environment, and, how do we use and basically look at transaction, business within this particular environment. And this, we've talked about different types of market, structures of market. We've looked at types of businesses, private and public sector. But today, once you have a business and the business is formed, what we need to now be able to do is basically run the business. And for running the business is what you need essentially is money. And the accounting side of things, in terms of the importance of accounts for business, is going to help us understand where the money comes from, where it goes, how much is required, and what are the key statements which are required to be produced, because you're running a business, or and in this case there are legal requirements, and these legal requirements ensure, or at least warrant, that you need to be able to produce your financial statements, which are then going to be required, for submission to bank, investors, shareholders, that also looking at, obviously submitting to Companies House. Now, there's a fair bit of indicative content, and here, keeping in mind that we are looking at from the perspective of level 3, we are not going to be looking at going into too much details of accounting, but the idea here would be to get an overview and understand some of the key bits which we talk about when we talk about business, and when we talk about accounting or accounting department or function as a whole within that business. Now, before I get into in terms of understanding what is accounting and why is it required, I think one of the basic bits that we want to look at essentially is to try and understand, what do you mean by accounts? So what is accounts, or what is the meaning of the word, accounts? In anybody, if they can let me know and participate by unmuting the microphone, or, basically use the chat window. What do you mean by accounts? sometimes when you look at accounts, what we are looking at is an account for an event. You've witnessed an accident and you're providing an account. No, not from that point of view, but accounts from a point of view of accounting, finances. So sometimes the terminology, when we look at accounts, the dictionary meaning of that would be, you're reporting a description or an event or an experience. But when we talk about the meaning of accounting, what we are looking at is primarily talking about essentially the process which is required to be able to maintain and create, financial statements. So financial statements tend to be, the basic bits which basically provide, let's say the importance of money coming in and money going out, or the spend which the business is doing, essentially in terms of by using the function of accounting. Just like you have marketing, other functions in the department, in the company or in an organization, you'll have marketing, you have business development, you have HR, you have administration. In some cases, if it's a manufacturing organization, you would also have engineering, production, and other such departments. So in those cases, what you're going to be looking at is primarily the aspect of accounts or finances of the company being maintained, and they would generally be coming across from the accounting or the finance department. So when we talk about accounting from a point of view of business, we are looking at the systematic recording, analysis and interpreting of financial data, or money coming in, money going out, in short, and other examples of financial data, which could mean that how much money is being spent on purchases, income, salaries, other expenses, petty expenses, things like that, would all be considered under financial information which the business would be essentially collecting, and that would basically constitute what is called accounting. Now, accounting can be done by one person. Accounting, if it's a big company or a big concern or obviously a larger organization, then you might have a number of people working within the department, and that would constitute a finance department or an accounts department. And this would then have either one or many people working within the department, and they would be responsible for producing things like payroll, looking at taxation, looking at obviously producing financial statements, submission of accounts to investors, management, obviously company's house would be government. And then you'll also be looking at some of these statements or finances being produced for the purposes of management decision making. And that is where you would see accounting being important for decision making at the management level, because if money has to be invested or money has to be spent, obviously the management would in some cases look at what kind of return on investment will this money being invested bring. And that is where number crunching, the importance of accounting comes into business. Now, the purpose of accounting is you want to look at the financial position of the company at any given point in time. And obviously, if you look at finances from your end, when you look at an example, and I think you should all be able to relate to this, is that we all get paid, if you're working at the end of the month or at the beginning of the month. And then what you do is when your salary comes in or your wages comes in, what you essentially do is you do a bit of planning. And that planning tends to be looking at, okay, this amount will be going towards rent or mortgage, this amount will go towards food, this will go towards fuel, this will go towards, expenses or entertainment, this will go towards this subscription, gas, electric, things like that. So what you're doing essentially is at home, when you have income coming in or your salary coming in, which is treated as income, because that comes into your bank, what you do is then do a bit of planning. And that planning to be able to sustain and work through your finances, payments, receivables, is something that you're doing on a day in, day out basis. And that would also constitute what is called accounting. But in this case, you're doing it on your own household basis. So it might be accounting, yes, but I might term it as personal accounting, because essentially what you're looking at doing is maintaining the incomings and outgoings for that month basis the wages or salaries that you've received. So if I look at the month, that would constitute an accounting cycle. That means you're planning on expenses for that month. A lot of us are looking at taking holiday this month. So we must have been saving, maybe throughout the year, or maybe in this month we're looking at a bit of an overdraft, or spending and taking a holiday by spending through the credit card. What you're looking at doing is at some stages looking at repaying that money back if it's an overdraft, or if you've spent it or booked your holiday to a credit card, because some 45 days down the line, 50 days down the line, or 55 days down the line, you'll have the statement coming in from whichever credit card company or bank, and that would mean that you would need to repay that back, otherwise you'll fall in debt or you'll be in default. So in this case, this would constitute an accounting cycle. So there are lots of different things that you would essentially do. Some part of it would be done manually at your end, and some part of those would essentially happen because you can receive a bank statement, you can log in through your application or app on the phone and actually see your transactions, incomings, outgoings. And this would all, what is the purpose of doing and looking into all this is because you want to manage your finances better. You want to be able to essentially, work through what you've got, and obviously not fall in debt. You want to make a bit of saving. You want to make sure that all the expenses that you're doing are incorporated and accounted for. And this would then, if you're able to manage it successfully, and at the end of the month you're able to save a bit of money, I would say you've been successful in managing your expenses, because you're putting that money aside for a bit of savings for the future. And that would be the purpose of accounting, which is where you're looking at getting by and obviously paying for your expenses from the salary or the wages that you receive in the month. So we need to be clear about what is the purpose of accounting and why is it important. So if you look at personally, from a perspective of managing expenses in the household, bills that you pay or things that you buy or purchase are all to be paid for from what you're receiving as salary or wages. And that is a purpose. And when you look at logging into your mobile phone app, or when you look at your bank statement, when you look at your direct debits, you're essentially looking at managing your expenses on a day-to-day, weekly, and monthly basis. And this would constitute a process of accounting. Now, if you have to extrapolate this and take it to an organization, this is where the accounting department or the finance department would come in, and they would be looking at producing this in a more structured way, because the finances would need to be looked at by different people, and different people will have different requirements for looking at those finances. So if it's management, they would be looking at decision making. If it's an account manager, he or she is looking at paying invoices, raising purchase orders, making sure there's a credit. And if the credit comes to an end, the payments are made, the checks are released. And they are looking at money coming in, money going out, sales orders being generated, invoices being generated, purchase orders being generated, and then they being basically paid off at the end of the month to manage the expenses. And sometimes you would look at banks and companies and even individuals like us, we have an overdraft. So if you need, like most companies, what they have is a bit of an overdraft facility, with the banks, because at the end of the month, salaries have to be processed. And obviously there's a large outflow of money from the companies or from a business. So in some cases, banks and companies, when they look at their cash flow, okay, you're generating enough capital, you're generating enough money through the course of the month. So if you need a bit of extra cash towards the end of the month, then that will be replenished because you have invoices that you have raised and the money coming in from customers. So banks are able to see money coming in, money going out. And if they see that the amount of money coming in is lesser than the money going out, then sometimes banks would give you an overdraft facility because they see net income being more than net outflows or expenses. And for a certain extra delta or an amount, a fees, as I would put it, you would get an overdraft facility. Now, when we look at businesses, before I get into showing you a bit of a video, which will be a good overview of what I'm explaining, what I want to be able to do is look at what could be the statements which are produced primarily when we talk about accounting. When we look at the function of accounting within a business, there are different types of statements which are produced, and they tend to be what are called financial statements. Now, these statements generally tend to be of four types. They tend to be income statement, retained earnings statement, balance sheets, and cash flow statements. Income statements and cash flow statements could be produced by the accounts department or the person working in account on a weekly, monthly basis, quarterly basis. Balance sheets are also prepared. Trial balances are also done, part of balance sheet, but balance sheets are typically finalized towards the end of the year or when your accounting cycle ends. Most companies sometimes you hear this, and I'm pretty sure that you would have, and if you would have, you could say yes in the chat, is that a lot of companies produce, balance sheets at the end of the year because it is a requirement by law to be able to submit your accounts to Companies House for the accounting cycle. And we hear that sometimes. What I want to mention is that a lot of companies say we have a financial year end, or we have a year end coming up. Now, what are they hinting or mentioning by using this sentence? They are saying that their accounting cycle is coming to an end. Most companies have the accounting cycle from January to December, which is the typical financial year. Some companies have it from 5th of April to 4th of April, which is the HMRC year in terms of accounting. And sometimes companies, when they are formed on a certain date, like for example, you opened a business on the 1st of July this year, your accounting cycle will end 12 months down the line on 30th of June 2023. And that would be the accounting cycle in which you will be ending up producing these statements. Now, balance sheet and profit and loss account are required to be submitted, or balance sheet is required to be submitted to the Companies House because you're reporting the finances of the company as on that particular date. So the balance sheet would be finalized for 30th of June 2023, and that would be sent across showing the statement of finances of the company and financial affairs of the company when it is submitted to Companies House. But you would produce income statements, profit and loss account, statement of retained earnings, or cash flows, which would be required to manage the operations of the business in terms of money management of the business on a weekly, daily, monthly, quarterly, 6-monthly basis, and they would be important statements. Now, one of the other bits which I just want to quickly clarify before we get into discussing the assessment criteria, general bit of information is sometimes we hear a terminology called financial accounting, and sometimes you get to hear a terminology which says management accounting. Now, what is the difference between the two? So when I say financial accounting, or when I say management accounting, there are two subtle differences between them. And when I say financial accounting, what I mean by financial accounting is that we are looking at producing financial statements for the purposes of reporting to external users of the organization or stakeholders. If you recall, in the first learning outcome, we studied stakeholders. Stakeholders tend to be, internal and external. Internal tend to be, anybody recalls? Internal stakeholders tend to be stakeholders which could be employees, staff, management, board, the directors, because they are working inside the company, or they are basically directly related or associated with the company. But when we talk about external shareholders or external users, they could be partners, suppliers, government, community, banks, and they are somebody who are outside the organization. And what they are looking at is, if they have to look at how the company is performing on a financial basis, on a financial data basis, then they would be looking at what is called financial statements of the business. And financial statements of the business that I discussed are 4 different types: balance sheets, profit and loss account, cash flows, and income statement, and statements of retained earning. If the business has been running for a lot of years, what the bank would be interested, if you go to the bank and you want to take out a loan to expand or maybe buy some machinery, you want to buy a premises, and what the bank would be looking at, interested in finding out is, how much is the business generating in terms of profit, and what profits is it retaining over the years, which is now reflecting as savings or assets within the company. And that would be a statement of retained earnings. So it will be required to be produced by the accountant or somebody working with the accounts department to show how much money is the company earning in a given period, and how is that money being reinvested into activities of the business in order to increase the business turnover and profitability. And some part of it could be retained as earnings or profits by the business, and they would be required for the bank to scrutinize. They would say, okay, can we get the last 3 years statement of earnings? And that would mean they want to see how much money is being generated and how much profit the company is generating, and basis which they will decide whether they'll give you a loan or not. So when we talk about financial accounting, we are looking at producing statements of money and money-related operations, the finances side of the company, and they are basically being produced for external users. Now, These statements could be produced for the investors, shareholders. It is because requirement by law that you need to be able to submit these statements at the end of your accounting cycle, and all these would be required and the purposes of financial accounting. Now, when we talk about management accounting, what is management accounting? Management accounting is primarily, accounting which is related to producing reports which are going to be useful for the management of the company, directors, the board, the CEO. When I say directors, it could be the CEO, the CFO, or people who are involved in the decision-making process of setting the vision for the company, the strategy for the company. They are looking at basically, say, for example, if the company looks at expanding operations, going to another geography, they are going to be what are called long-term, short-term, long-term management decisions, decisions which are going to be taken by key stakeholders within the company, and they would require to see whether the company has the finances, whether the company has the ability to be able to finance those operations, sustain those operations. And that is where you would be looking at producing, what is called management reports. So when we talk about management accounting, and when we talk about, the purposes of producing these reports, we are looking at primarily understanding, analyzing, interpreting, and ensuring that the information required for decision making is accurate and is based on what is called, let's say, I would say, based on the finances of the company. Now, here, the main objectives tend to be that you're looking at taking important decisions which will require money or finances to be invested. It could be because you're looking at planning future business activities. It could be because you're looking at, let's say, ensuring that the company has enough money to pay the salaries of its employees for the future. And this is what essentially would be the remit of management accounting. So here, the focus is on cost, the focus is on accruals, the focus is primarily on money coming in and how much money is required to run the day-to-day operations of the business. And they would be essentially what will be constituting what is called management accounting. Now, with this background in mind, what I also want to do is basically show a video, which is a couple of minutes, and we'll watch this video, which is primarily to show what is the importance of accounting for business. And obviously, we're going to hear from one of the person who has worked within a company and an organization, as she's trying to explain why accounting is important for business. So let's listen in. I think it's a 7 to 8 minute long video. What we will do is basically listen to some important parts of it, because there are bits and pieces that we are going to be discussing in this particular video. Once we have listened, once we have heard and obviously listened in to what she has to explain, and obviously it will add to some of the important bits that I've explained while we have discussed the few slides.
In this video,
so let's look at. Let me share the screen so that we can look at this video.
how he runs his business.
So let me just share this particular screen, and we will start off with this. Now, just to check with everyone if they are able to see the screen and obviously hear, the video. So let me just expand this slightly and let's start.
Business in Italy. Before we start, story about Claudio and how he runs his business in Italy. Before we start, let's just get clear on what accounting is. Accounting makes it possible to systematically record, analyze, and report important financial information and communicate the financial health of a business to all interested parties. It's called the language of business, and it's the backbone of any company, because every business needs reliable data to make informed decisions. But what does that really mean? Let's just take a moment to make this a bit more transparent and understand the basics of accounting. So let me tell you about Claudio.
So we're going to be looking at
Imagine
discovering some of the accounting basics by looking at an example of how someone is running a small business.
which is also one of my favorite places. A nice beach city where a man called Claudio is selling souvenirs to tourists. He only sells one item, a beautiful plate made from colorful glass. In the morning, he leaves his home with 100 euros and goes to the manufacturer of the souvenir. Each plate costs €1. So Claudio buys 100 pieces with his 100 euros. He walks to the beach and sells the plates to tourists for €5 a piece. And by noon, he's sold out. He goes home happily and repeats the same process the next day. After a month, he wants to know how much the business made. What if he sold more than one item? Which one was more profitable? Would it make sense to expand his business, like rent a fixed stand at the beach? Without a way of recording the daily activities of his business, he's not going to be able to answer his question. Accounting makes this possible. Not only will each financial transaction be recorded, but Claudio will also get detailed reports summarizing his financial performance. We call these reports financial statements. Let's start with Claudio's profitability. If you want to find out about a business's profitability, you go to their income statement. This is one of the main financial statements. There you can find out how much sales a business had in a certain period, which costs, and what was the resulting profit or loss. There is another name you may hear for the income statement. Do you know what it is? P&L, for profit and loss. It's a fairly simple business model, and the P&L for Claudio's business would look like this. He sold 100 plates for €5 each. That's what we call sales or revenue, which were €500. The plates he sold, he didn't get for free, right? He incurred costs to buy them. Each plate cost him €1. Therefore, in total, his costs were €100. We call this the cost of goods, which we need to deduct from revenue. To keep it simple, we don't consider any other costs for now, like fees and taxes. If we add this up, we can see that Claudio made a profit or net income of €400. That's how a simple income statement would look like. Next, we're going to take a quick look at the second main financial statement, the balance sheet. The balance sheet shows which assets the company owns, the liabilities it owes to others, and the equity that belongs to the owners. Assets are usually things of value or resources the company owns and uses. For instance, land and buildings, office equipment, inventory, or cash, just to name a few. Liabilities are what you owe to others. For example, a bank loan, or what you owe to your suppliers for goods or to the IRS in taxes. The third component is equity. This is a bit more abstract. It's the residual amount that would be left if the company sold all its assets and paid off all its liabilities. In other words, it's the difference between total assets and total liabilities. This leftover money belongs to the owners of the company. In the balance sheet, the assets are on one side and equity and liabilities are on the other side. If you draw a line between the two and one on top, it looks like a T. This is what accountants use to visualize accounting transactions. It's a very helpful tool, and we're going to come back to these T accounts all the time. You can see that the left side of the T is just as big as the right side. That's because everything the company owns, its assets, was purchased either from debt, to somebody else's money, or its own money, meaning equity.
Through my online store alone, we've sold over $500,000 worth of spices. That's so great.
For money to go to one account, it has to come out of another. We call this a flow of economic benefit from a source to a destination. We already said that assets minus liabilities equals equity. If we rearrange this like this, we get assets equal liabilities plus equity. Both sides are always in balance, hence the name balance sheet. And that is the foundation for any accounting system. The accounting equation. Total amount of assets equals total liabilities plus equity. Both sides are in balance. With that in mind, let's see how the balance sheet looks like for Claudio. The balance sheet is always created at a certain point in time, like at the end of the business year or at the end of the quarter. In our example, it's the end of Claudio's business day. Claudio started out with 100 euros in cash, which is also the money or equity he put into the business. The cash on the left side equals equity on the right side. The balance sheet at this point is in balance. Then he spent the cash in the morning to buy the colorful plates. The plates are what we call his inventory. In the process, his cash got reduced to zero, but in exchange, he received another asset, inventory. He didn't get richer or poorer by that, right? The total amount of assets is still 100, and of course, his equities too. After he sold the plates for 5 euros each, he ended up with 500 euros in his pocket at the end of the day. His inventory is gone because he sold all the plates to the tourists. At the end of the day, his inventory value, therefore, is zero. He doesn't have any more plates. If we look at Claudio's balance sheet at the end of the day, we can see that the total value of assets, the left side is 500 euros. That's the cash he came home with. On the credit side, we only have 100 euros. The balance sheet is out of balance. As we know, this can't be. Both sides always need to be in balance. If we look at Claudio's balance sheet, the missing component is the profit he made during the day. If we go back to the income statement, we see that Claudio's net income was 400 euros. This will be added to equity. Why? Because due to his successful business, he made the business more valuable. When he started out the day, it was worth only 100 euros, which was the money he put into the business when he walked out the door. When he came home, he had sold all his plates with a profit of 400 euros. So his business is now worth more, which is reflected in a higher equity. Net income is the link between the income statement and the balance sheet. So when we add the profit of 400 euros he achieved to equity, also the right side gets to a total of 500 euros, and the balance sheet balances like it should. So that's how it would look like for Claudio at the end of his successful day at the beach. I hope this video was helpful for you to get familiar with accounting basics. I'm planning to add more videos for.
Now, as you can see, basically what she has been able to explain with the help of the video is to help us grasp some of the basic statements which are required to be produced when we are looking at the purposes and importance of accounting for a business. Now, what I've done is when we get into understanding what is the importance of accounting for a business, we can summarize this in a couple of ways. And I think this is something which is important because this is something which should come to you pretty much naturally. So the moment we talk about finances, we talk about money, we talk about reasons of why accounts needs to be done or transactions related to money need to be recorded within a company. And that process, being the process of accounting, is required in order so that the company can track the expenses, the income coming in, the invoices being generated, the purchase orders being issued, the petty cash being given out, or any sort of an expense being done, whether it's in terms of shares, dividends, which are being provided at the end of the year if the company does well, bonuses, incentives to employees, all that sum total of financial transactions would be, basically the process of, doing accounting. Now, there are 5 main purposes of doing this. And in whatever way we look at, these are the ways that we need to be able to, always bring it out when somebody is going to ask you, what is the importance of accounting for a business? Number 1, you want to be able to record transactions. Number 2, you want to be able to monitor the financial activity or the money coming in and income coming in and income going out of the company. And that is basically monitoring finances for the company. The third is you're looking at controlling the expenses and finances for the company. So expenses control means that you want more money to come in and less money to go out. So obviously you're looking at weeding out any sort of an expense which is considered a wastage for the company, in terms of either too many dinner parties or organizing too many events. And if they're not bringing the benefits, at some stage the management would take a call and say, okay, these promotions, these activities are not making any sense and they're not bringing any additional business. So obviously the idea there is to control the management looks at it from a point of view of managing the business. Because if you have money in the business, if you have money to spend, if you have money to invest, you have money to pay salaries, you have money to buy things or expand the operations, that is where the decision making tends to happen. So money makes the world go round. That's a saying that we've all heard. And obviously it is a very important part of how the key people, owners, founders, directors, senior management of the company look at making decisions in terms of how the operations of the business on a day-to-day basis have to be managed. How many employees? Sometimes you see, which I give you an example of, is that during the COVID pandemic, a lot of companies made a lot of people redundant because they weren't seeing the business coming through. The sales had declined or were declining, and there was no new business coming in because of restrictions of lockdowns and obviously the pandemic situation. And what a lot of companies did was, it was a management decision in order to save the company and save the cost or bring down the cost. A lot of companies and managements in management director, people in the management or directors of the company decided to, make people redundant. They put people on furlough, and that is where the government came to the rescue. And they said, okay, if you don't lay off your employees or don't make them redundant, the government would give you a facility to be able to pay the employees through the furlough scheme. So this was a management decision. Now, last but not the least, how do external organizations like banks, investors, or when you go to third parties to raise money for the expansion of business, or basically look at members of the public, when you look at a shares issue, how do these members or members of the public actually get information about how good the business is, how profitable the business is? They need to be able to see the financial performance of the business, and that is where these financial statements are produced. And that is one of the most important reasons why accounting is done within the company or within a business. Now, when we looked at that video, she was talking about different types of financial statements, which we have also discussed. And what I've done is dressed up some of the slides in terms of adding a few tables which make it easier for you to understand in terms of what is management accounting, what is financial accounting, what is the difference between the two. And then we talked about these financial statements. So what I've done is to be able to recognize these and the importance of these statements, I have to put together one slide each, just to summarize that what is an income statement. So when we talk about financial statements, there should be something straight away coming to your mind to say there are 4 types of financial statements. You have income statement, you have cash flow statement, you have statement of retained earnings, and you have the balance sheet. Now, these are produced from time to time for various reasons, depending on what they are required for. But generally, they are the ones which are going to show how the company is doing, how the business is doing, and they tend to give different. These statements are different, and they give out information in a different aspect. So when we talk about the income statement, we are talking about the financial status or the incomings and outgoings, within the company. So what is the company making, or the business making, in terms of revenue by sale of its goods and services? What are the operating expenses? And then how are these, if I separate the operating expenses from the income coming in by the sale of goods and services, what is the net income which is available for the company to be able to pay off, salaries, dividends, and, make further investments into the business. This all data generally comes from the financial statement, or in this case, the income statement, sorry. Now, when we talk about balance sheet, a balance sheet is going to be, when we talk about balance sheet, what is a balance sheet? A balance sheet is basically a statement of finances of the company as of a particular date. It gives, I think in the video, if you recall, it showed that it is a combination of, two columns, which I will, left and the right hand side. And on the left hand side, you should have assets, which could be, the infrastructure, the machinery, the plant, the cash the company has in the bank, or basically anything which is an asset, something that you essentially, own, and you can actually sell immediately if required to generate money. So when we talk about asset means something which is useful for the company, valuable, resource for the company, and that would be classified on the left hand side. And balance sheet consists of assets and liabilities, and this is a figurative, way of seeing how, the balance sheets are made. So balance sheets are in two columns, assets and liabilities, and then you have the equity side of things added to it, which is primarily, shareholders' equity, or if you have generated, capital essentially from the market, from investors, and they tend to be, the equity, which is also added to the balance sheet. So the quality of how the value of the company, in terms of its shares, if the company has been listed on a stock exchange, then the equity is also looked at, because that tends to be that at the end of the year, the company needs to pay back, dividends to the shareholders, or they need to pay in, additional interest, or long-term loans if they have been taken as bonds, or, let's say overdraft facilities which have been taken to look at long-term investments, they have to be paid back, and that is also a part and parcel of the balance sheet. So when we talk about equity is basically the total assets minus the total liabilities, and this is a figure that you can actually find in the company's balance sheet, and this is something which is required, by banks and investors, for them to be able to look at, when they look at the financial statement like the balance sheet. So a balance sheet primarily, is a report of the company's assets, liabilities, and shareholders' equity at a given point in time. It is a snapshot, in short, of company's expenses, income, what the company owes in terms of money to the market, to the bank, and that is, a financial statement which is basically going to provide a summary of the balances the organization needs to, let's say, when I say balances, what I mean by that is the money that is owes, to different, say organizations, and the money or the assets or the, something valuable that the company owns, and it shows that, for a particular date in time, and that would constitute what is called the financial statement, which is balance sheet. Now, balance sheets obviously have two sides, as was explained in the video. So it is normally assets, liabilities, and equity, and that is what, is reflected for as of date in terms of time for companies, finances. Then we talk about, profit and loss statement. Now, when we talk about profit and loss statement, what we basically mean by that is that when we talk about profit and loss as a financial statement, it is going to help summarize what are the revenue, cost, and expenses which the company is incurring at any given point in time, over a month, over a quarter, over 6 monthly period, or across the year. And these statements are generated, almost on a weekly, monthly basis by accountants or people working within the accounts in the company, because the company and the management would be interested in understanding how much sales have happened this month, what is the expenses, what are the outgoings, what are the incomings, and what would be the net profit the company would have, at the end of this month. And this is a typical statement which is provided to the management at the end of every month by the accounts department, because it gives a status of the company's financial side of things from a point of view of money coming in, money going out, and what is the net income or profit which the company is generating on a monthly basis. Then we talk about what is called the cash flow statements. Now, when we talk about cash flow statements, what we essentially mean here is that we are looking at understanding, what is the amount of cash coming into the company and what is the amount of cash which is, going out of the company. So when we talk about these statements in general, what we are basically doing at any given point in time is that we are interested in finding out that what is the money available within the company from a point of view of spend if the company needs to do. And this is something which is important from a point of view of senior people or management within the company, because they are interested in finding out what is the the amount of money coming in to the company through sales by selling of its goods and services, and obviously reflecting the income which the company is able to generate when we talk about cash flow statements. So these statements tend to summarize the movement of cash. If I say what is the cash coming in and going out, so movement of cash which is coming into the company and going out of the company. How would the cash come into the company? When the company generates invoices, when the company sells products. So you're going to be issuing an invoice to a customer, and when the customer pays that invoice, you're going to receive money into the company. What is the money going out or movement of cash going out? The company is issuing a purchase order. That means the company is buying raw material. For example, if it's a car manufacturing company, the car manufacturing company would be looking at buying lots of different types of products which are going to be utilized in the assembly of the car, things like tires, you're looking at seat covers, leather, interiors, things like that. It might not be all produced by the same car manufacturer, but it'll have other smaller companies producing these goods, and they would be supplied to the main car company like Nissan or Toyota in Sunderland, and they would then be integrating that into the car factory and then selling it as a final product through dealerships. So when they issue purchase orders to their suppliers to buy tires, to buy chassis, to buy, say, for example, components which are required to be able to manufacture the overall product, which is the car itself, air conditioning units, for example, they would be issuing what are called purchase orders, and that is money going out of the company. So statement of finances showing, statement basically showing money coming in and money going out, or movement of cash, essentially, not literal cash, but it could be going through the bank and things. In some cases, in smaller businesses, it could be literally the cash. If you run a grocery store or a newsagent shop, you might be buying, products from, say, the Smith market, in Ashton-under-Lyne every day. You're buying the daily fruit and veg. And in some cases, some of these businesses would buy it on cash. But generally speaking, all businesses would have credit lines with their suppliers, and it is the purchase order which they issue which will show that the money going out is being tracked through the cash flow statement. So when we talk about these in general, we are looking at the cash flow statements summarizing the amount of cash coming in and going out. So basically the movement of cash from the company. It will also show what is the cash which the company is generating. And this statement would be at some stage used to produce a balance sheet, because this would, a balance sheet or an income statement, because they would be showing the net movement of money happening within the organization. Now, these are the four basic types of statements that we look at primarily, when we talk about, various types of, say, statement of, which are produced. So if we look at what you call, the statement which is primarily for retained earnings, that would generally be, something to do with the fact that it is prepared within the company because they want to show, what is the amount of cash or the money which the company is actually retaining as profits within the organization. So a statement which is produced, and I mentioned this earlier, a statement which is produced or would be asked by the bank in terms of showing the finances of the company in detailing out the amount of money coming in and how that money is being retained within the organization as profits is what would be the statement of retained earnings. So here, when we talk about the statement of retained earnings, we are looking at understanding what is the amount of money the company generates over a period of time, and the reconciliation, or the when I say the reconciliation, means the end start at the beginning, or the start and the ending of that accounting period would essentially show the amount of money which is finally got retained in the company, because net income minus the expenses would give us the earnings or the net earnings which the company has made, and that would essentially be reflected as the statement of retained earnings within the organization. Now, the statement of retained earnings is also sometimes called the owner's equity statement, or a equity statement, or a statement for shareholders, because this will show the amount of money which is left in the company, and that would be utilized by the company to essentially pay dividends to shareholders, to investors of the company at the end of the year. And that is why this is also important, because it shows the amount of money the company generates and the money it is able to save as profits, which is going to add to the balance sheet in the asset side, and then they could be used for investment in the future, for expansion of the business, for investment into new premises, new manufacturing facility, or buying the plant and equipment, and also in the form of paying dividends to its shareholders, which is what the statement of retained earnings actually does. Now, if I have to say that you want to look at a statement of retained earnings, it could be something which is shown generally in the balance sheet, or in one of the columns of the balance sheet, and that is what it would reflect as over the year. So if this amount is increasing over the years, what will mean is that the company is generally profitable. It is generating a fixed amount of revenue, or increasing amount of revenue, and this is allowing the company to look at expanding, and obviously the company's operation becoming bigger and obviously much more profitable. And here, what it does to the company is that the financial investors, or in people who are investing in the company, generally are feeling more confident, because it shows that the company is able to increase profits or increase its business and turnover in the market. And even though if it faces competition or things like that, but it is still able to maintain the growth which it requires in order to sustain and increase its business is happening. And that is why this statement would be important. This is also going to be important because if the company looks at taking out a loan, goes to the bank, then in those cases, the statement would essentially allow the banks to see whether the business is increasing, is profitable, and are they generating enough cash to be able to sustain the operations of the business. And obviously the bank would then decide that, okay, yes, we are going to be able to give a loan or an overdraft facility to the business. Now, any questions on this so far? Any questions so far of what we've discussed in terms of the key financial statements, the reason why we look at accounting, and how do we look at, and what information these statements provide when they are presented to different people within the organization or external to the organization. Right. Let's move on to understanding the second part of why accounting is important. Because accounting is important because it also gives a picture of how the business is doing. Now, sometimes we have to look at this from a point of view of understanding what is called the ratio analysis. And there are different financial indicators of this ratio that we get to see within the business. Now, these ratios are classified across 5 different types: liquidity, solvency, profitability, financial efficiency, and repayment capacity. There are lots of different types of ratios. But when we talk about ratios, there are 16 different types and they are categorized in these 5 criteria. They give us or help us calculate. If I'm a financial analyst, if I'm a management accountant, if I'm an investor, if I'm a shareholder, if I'm a bank or a financial institution which has interests in the company, for example, Tesco, what I would want to find out is how the business is doing. And these ratio analysis or ratios, the 5 different types that we discussed: liquidity, solvency, profitability, financial efficiency and repayment capacity, are going to be able to tell me more details about how the business is doing and what are the finances of the business, at any given point in time. Now, these ratios have further different types, and we can, if we look at all the different types, they help us calculate various parameters of how the business is doing from a financial perspective, and there would be 16 different types, but they have some limitations, and obviously they are used in certain situations. Let's broadly look at what are the 5 different types of ratios. Now, when we talk about liquidity, in general, if I talk about ratio analysis, they would be 5 broad categories, 16 different types of ratios. And a ratio analysis is basically a quantitative method which will allow analysts to gain insight into companies' liquidity, which is primarily, when I say liquidity, what do you mean by liquidity? Anybody, in terms of any idea, when we say liquidity, it is the ability of the company to be able to convert its assets into cash. Now, if I give you an example of a small business, if it's a small manufacturing business, like obviously Manchester was very famous because it was the heart of spinning mills during the industrial age. And we look at spinning mills or mills which basically produce and spun cotton and obviously create clothes. If we look at that as a small business, the business would have assets. What is the asset? The machinery that it has is an asset. Now, if the business is to sell that machinery, it is able to realize some cash by the sale of that machinery. How much cash is not the important criteria. If it's a used machinery, if it's a 10-year-old, if they're selling it as scrap, if they are looking at selling something which is new, they would be able to generate some cash, and that cash would be something immediate that the company would be able to generate. Liquidity would also mean that if you have money in the bank, you can withdraw that money. That is, liquidity. That means cash at hand. So when we talk about liquid assets, or when we want to find out how liquid the business is, that means how much cash the business can generate by the sale of its asset, or the business, the money that it has in terms of cash at bank, that would primarily constitute what is called liquidity. Now, the ability of the business to pay off its current liabilities would be, used by relating it to liquidity. So if you have a lot of debtors, that means you have a lot of suppliers who you owe money, or the business owes money. And if you have cash to be able to pay that off straight away, then it shows that you have the ability to be able to manage your expenses by paying your creditors off. And that is something that is generally done through the purposes of what is called the liquidity ratio. Now, a liquidity ratio essentially would be used to determine the company's ability to pay its debt in terms of short-term obligations. If the company has to pay salaries to employees, the liquidity of the company, the liquidity ratio would be used to primarily calculate the liquidity of the company. And this tends to be generally by the use of formula, which basically is, either current ratio or quick ratio, because there are different types. And this would be calculated using, formulas. So if I look at this particular formula, obviously, when a company's liquidity has to be calculated, or the ability to be able to pay its short-term debt commitments, you would look at liquidity ratios. There are 2 different types: current ratio and quick ratio, which is current asset by current liabilities, and quick ratio is liquid assets by current liabilities. So if I have to pay salary at the end of the month, I would be looking at liquidity. How much cash does the company have at bank to be able to pay those salaries? Now, the accounts manager would normally do this calculation, and if they don't have enough cash because this month has been heavy on purchases or low on income coming in, they would speak to the bank And obviously the bank would look at using quick ratio to see what is the previous month's incoming and outgoings, and then decide whether they will give you an overdraft or not. And this is a way to calculate the ability of the company to be able to pay its debt by using and looking at, liquidity ratios. So two different types, quick ratio and current ratio, and this is where the formulas come in. Then we talk about what is called solvency ratio, the second type. Now, when we talk about solvency ratio, what we mean by solvency ratio is a key matrix which is used to measure the company's ability to meet its long-term debt, obligations. So the difference between, liquidity ratio and solvency ratio is liquidity is short-term commitment obligations, and solvency ratio is long-term obligations of the company, the ability of the company to be able to pay its debt or its creditors over a period of time would basically give us the financial health of the company. And this would be used to determine the likelihood that whether the company would default in paying its debt, or whether the company would obviously be able to manage and make its payments on time. And that is normally done using the solvency ratio. Now, how is the solvency ratio calculated? If I look at the solvency ratio calculated, it basically is calculated by dividing the company's after-tax total income, adding depreciation minus the sum of liabilities, and that would be the way to calculate, the solvency ratio for an organization. So if you have short-term liabilities, you have long-term liabilities, and you have depreciation. So what you will do is, in order to find out solvency ratio of the company, you are going to be deducting the short-term, the net income of the company with adding the depreciation and then subtracting the liabilities from it to be able to arrive at the position whether the company is able to meet its, long-term debt commitments or not. And that would be the formula that we will use, to look at calculating solvency ratio for the company. Now, they can be of different types: debt to asset ratio, equity to asset ratio, and debt to equity ratio. Now, we won't go into details of these, but these are different types which basically are utilized in order to calculate, different types of solvency ratios. And in some cases, they are required, to go into details of how the company is going to be looking at managing its long-term debt by looking at, say, diluting the shares in the company, how the company would look at managing its equity, which is obviously the shareholders' equity, the investors' equity, by looking at its total assets over a long-term period of time, and then also looking at, what is the debt it needs to pay in short oblique long term, and how is the assets, the value of the assets faring of the company over time. Now, we need to come across to the third type, which is talking about, profitability ratio. Now, when I talk about profitability ratio, what we are basically looking at is the ratio which is required to look at, when we want to talk about the financial metrics of the company, to assess the ability to be able to generate earnings relative to its revenue. That means what we are looking at is the company able to generate enough profit and, let's say revenue by selling its goods and services, which is going to be able to pay its costs, which is operating costs. Operating costs would mean things like electricity, water, wages, salaries, those are going to be operating costs, which are for the business. And will it have the ability to be able to make payments for those costs would be the use of looking at financial, in one of the ratios, which is within the financial ratios, the profitability ratio. Now, this ratio is generally used by analysts and investors to measure whether the company is able to generate enough, income relative to its revenue to be able to cover the operating cost over a period of time. So if I have to mention that what is profitability ratio would essentially be a combination of three things. It will tell us whether the rate of return on assets is good, whether the return on equity is good, and whether it has enough operating margins or costs to be able to generate money to pay for its expenses. And they would be, coming under what is called the profitability ratio. Now, profitability ratios take into account a lot of things. So when I talk about profitability ratio, if I just show this as a bit of a mind map, profitability ratios would have margin ratios and return ratios. We won't get into detail, but as you would see that what is the money the company is able to make minus income coming in and the expenses, what is the money it is able to retain as retained earnings or profits, what is the net profit in a product that it manufactures. And an example that I would give you here is when I look at the iPhone, just as an example, Apple as a company looks at calculating profitability on each of the product it sells, like the iMac, the iWatch, the iPod, the iPad, the iPhone. Now, if you are working within the iPhone department of the company and you are a product manager, or you are the one who looks at what is the profit which this product generates for the company, you would be looking at, calculating what is the net profit per sale of iPhone the company makes, what is the percentage that the company provides and has to pay to its suppliers for components. And you would be basically looking at calculating all this, and this would basically be looking at giving you an idea in terms of how much business or profitability does the iPhone contribute to the overall Apple business. And that is where investors and analysts would be interesting. So sometimes when they say the company is showing growth potential, the reason why they say the company is showing growth potential is because the profits for the companies are increasing year on year, on month, quarter on quarter, and it is showing robust growth in terms of sale, bringing in more revenue, increased turnover. And that means the company is able to pay off its expenses in terms of operating costs, things like wages, salaries. You're looking at bills and expenses like rent, electricity, lease costs, things like that. And it would mean the business is generating enough cash, which is able to pay off the income and expenses, pay off dividends to shareholders and investors, pay off its suppliers, and yet have money that they are going to retain as earnings in terms of profit and add it to net profits, because the profits accumulated over a point in time, would be increasing in terms of statement of retained earnings. And that would be the usability of what is called the financial ratios, which is specifically profitability ratio. Now, briefly going across to, efficiency ratios, when we talk about financial efficiency. Now, efficiency ratios in general, include ratios like inventory turnover, asset turnover, and, receivables turnover ratio. There are a number of different types that I've listed here. These ratios are basically used to find out how efficiently a company uses its assets to generate revenues and to be able to manage those assets over a point in time. A simple example that I would give you here, if I mention that if it is a manufacturing company, now, if the company starts off the business in this year and it buys new plant and machinery, what is the life of that machinery? How would the company use the machinery or the equipment that it is bought to be able to produce goods and services, and that it will sell over the years? And what you're looking at is the usability of the asset. The machinery has a lifetime of, say, 10 years. Or sometimes when you look at, the iPhone, if I stick to the example that I've taken earlier, iPhone battery has a recharge of 1,000 cycles. So after 1,000 cycles of battery recharge, your battery would need to be, would either start decreasing in terms of giving you the battery backup it provides, or you would need to replace the battery because the battery has gone through the 1,000 cycles. That is the lifetime of the battery's, ability to be able to provide, battery or backup on your phone. Now, when we calculate this, that is where we are looking at calculating how the company can actually use its assets. So in this case, plant and machinery equipment, to be able to generate revenue from it, and the ability to be able to keep its asset in a healthy condition so that they keep working for a longer period of time. And there is where we would be looking at using the efficiency ratios to calculate, various parts of the, the ability of the company to be able to maintain those, plant equipment and machinery. Another example that I will give you is for inventory ratio here would be that if the company, let's look at Heinz, or as a company which produces, Heinz beans, if you look at Kraft. Now, beans, when they produce baked beans, they produce has a shelf life of a year. Now, if the inventory is to go sour and if the product does not get sold, then the inventory becomes, will have to be destroyed or sent to a landfill. That would mean that if they produced too much inventory, in terms, say, for example, if the company sells, say, 10 million cans in a year, and the company has produced 15 million, and if the company's sales does not increase, then those 5 million cans will have to will go waste, and they will have to be destroyed, because the expiry date would mean that the product would become unusable. So in those cases, what will happen is there is a cost of that inventory. If the company decides to produce and keep it in storage, and then obviously before it expires, if it's able to sell, it's able to realize the cost by selling that inventory. But if it is not able to realize that cost, then it goes waste. That means the company would incur a loss, because they would have put in some money to be able to produce those cans, the raw material, which is beans, and they would have paid their suppliers, farmers, and some of the suppliers, and that would mean the company would not be able to that inventory. It will incur a loss, and that would be used that would be calculated by using what is called the inventory turnover ratio. Now, last but not the least, we want to look at repayment capacity ratio. Now, what is repayment? Repayment is the capacity to be able to borrow money and then repay that on time. A simple example that I would give you here would be when you have a credit card and you use that card to buy some goods or products from the market. And if you're able to repay that within the time frame that you are allocated, you would see that you do not pay any interest, because you have managed your finances in such a way that you use the credit card to get 55 days credit, and then you've paid the full amount off, before the company would charge you interest in the statement, in the monthly statement it comes. So your ability to be able to pay that debt on time is what will be called as your repayment capacity. Similarly, a company, when it borrows money from the market, from the bank, or gets a credit line from its creditors, suppliers, partners, and it's able to pay it back within that time frame, then that time frame in which you're able to pay it back would be used to calculate what is called the repayment capacity. And a repayment capacity, is important because it allows decision making to happen in the minds of borrowers, investors, banks, to see whether the business is able to pay its debt back on time, whether it's able to maintain its statements in terms of payments, not statements. Example again, you buy a car and you buy it on hire purchase. So what you're looking at doing is you're paying monthly installments. You've taken out a 5-year loan. You buy a house on mortgage. So what will happen is when you look at taking that loan out from the car company or the dealership, they are going to be able to do a credit search on you. A credit check would be done, and a credit search would come back and obviously say that you have had loans in the past, or you've taken out money in terms of loans in the past, but you've always been able to pay it back and your credit score is good, and the loan would get approved. But if they see that defaults have been happening on regular payments of loans or mortgages that you've taken out earlier, then they would consider obviously looking at your application again, because they would see that the repayment capacity of the individual, or in this case the company, is not there to be able to pay its loans or its debts back on time. And that would be something which the company would be looking at from a point of view of giving you further loan, or the ability to be able to borrow loan from the market. So when we talk about repayment capacity ratio, we are looking at computing the debt repayments that you are able to make, along with the principal and the interest on that principal over a period of time, and that would be termed and calculated using what is called the repayment capacity ratio. So these are important ratios which primarily help, in investors, banks, internal, external people to be able to decide whether the company's financial operations and its operations in general related to money and expenses are essentially being managed in line with the requirements when the company decides to take out a loan or take out, say for example, borrow money from the market. And that is where these ratios tend to be providing insight into the finances of the company at any given point in time. Now, this is where we come to an end in terms of this particular discussion in this session. And I hope that you have understood, although if we look at this particular part in terms of that we had to look at understanding the importance of accounting for business was only one assessment criteria, but we have done a bit of a detailed discussion because the idea here was to try and provide you an overview of what is accounting, when it is used, what are the reasons of why accounting is used, and we wanted to look at covering the indicative content which has been provided in a bit more detail, and that has hopefully given you a detailed overview of how accounts and finances are important, for the company. Now, with this, we come to an end, and obviously there is some additional reading which I would recommend that you should do, and that would give you a good amount of understanding in terms of what I've discussed and what I've delivered in this particular session. So my suggestion would be to primarily look at this particular website, which is a good blog, which talks about what is accounting for a small business, and then it gives out some detailing in terms of how this can be useful for people working within this department or within this function to get useful information out of it. Now, at this stage, what I would want to do is obviously take any questions. If there is things that we have discussed and you want to understand in a bit more detail or have not been understood, then I would like to take any questions at this stage. So any questions on today's discussion that we've had in terms of understanding the importance of accounting for business? So are there any questions at your end? Any questions at your end, Nathan? Any questions, Mohsen? Taylor, any questions at your end? Farhana, any questions? Mudassar, any questions at your end? Shabir, any questions at your end? And last, Adila, any questions at your end? Right. If there are no questions for now, that's absolutely okay. If you think of any, you can obviously drop us an email on litc@ukversity.co.uk. There are one or two good handouts which I'm going to upload on Moodle along with a copy of this presentation. I hope that you have been looking at Moodle and going through some of the bits which were discussed in Learning Outcome 1, Part 1 and Part 2. But there are these good handouts which I'm going to upload, which are primarily going to be just quickly showing them to you now before we look at closing the session. And they would be useful for you to look at from a point of view of what is accounting and accounting basic. So this particular handout, which I'm going to show you now, is the one that I would want you to hopefully go through. It talks about the accounting basics. And as we saw in that video, the lady talked about a business and, explained how the person goes about, carrying out his various accounting activities. And this particular handout, which is about 17 to 18 pages, would be useful for you to do your assignment as well. Would talk about the basics that we've covered today, types of income statement, types of financial statement, what are the differences between management and financial accounting, and some of the key terms that we've discussed while discussing some of those statements and looking at, individually each of the statements just from a point of view of visually understanding how they look like, or what are they like, and obviously how they look and how they are prepared. There are some examples which are given, and I would suggest for those of you who are looking at some additional reading, this document would kind of provide you, the summary in a very, very good, concise way for what we've discussed and covered in today's session. So we will meet again next week and we'll discuss Learning Outcome 3. Till then, take care. Thanks for joining, and bye for now.